Today on InvestTalk, we discuss how the large Fed rate cut will impact the consumer. Then we reveal why the market hit an all-time high today. We also answer questions about Schwab, American Electric Power, VF Corp, and more. And then at the end, I discuss a fraud trend sweeping the world.
This is InvestTalk, independent thinking, shared success.
Now, our main focus point today is about the impact the rate cut from the Fed yesterday will have on the average consumer, probably you, right? We know that this is the first decrease in rates in 4 years, and that's after the Fed had raised rates to a 20-year high, okay? And it's been that way for over a year. So this is welcome relief for a lot of consumers that rely on cheap borrowing. And luckily inflation has come down. It's 2.5% to 3%, depending on which measure. The Fed's their favorite measure is around 2.5%. Now, when will the average consumer start to feel the effects of the rate cuts? Now, for most people, it's going to be in the securities market, right? We've seen that as of late. Right, equities rallying, new all-time high. Obviously, markets like that rate cut. Now, remember, the market is a discounting mechanism, meaning that this will trickle into the economy over time, just as the rate increases trickle through the economy over time. And in many ways, we're still feeling the effects of the last rate hikes. Now, the first place people will feel it is the mortgage market. Why? Because it's directly linked to the capital markets. It's linked to the 10-year Treasury rate. As I said before, the 10-year peaked out earlier this year at about 4.7%, and now we're closer to 3.7%. Okay, so 100 basis point drop in, call it the last 6 months. And the Fed only cut 50 basis points, right? So that means that the 10-year is priced in more than at least pretty much all the rate cuts expected for this year already. And that translates into lower mortgage rates. Peaking out at nearly 8%, now we're back down to around 6% in some cases. So that's where the most immediate impact will be on actual consumers. Now, what about other types of loans? Well, auto loans, they closely track the Fed's interest rate path. Why is that? Mainly, it's already had some impact, but it mainly has to do with, those that are lending, they're borrowing short and lending long. And so when the Fed cuts rates, that's where the borrowing costs actually get cut when the Fed actually cuts the rates. Where else will there be impact? Credit card debt. Now, it won't be a huge difference, right? 50 basis points, you're talking about going from maybe 22% to 21.5%. Not a huge impact overall, but still there will be some impact there. Now, where it won't really impact it will be student loans. It's not affected by the interest rates in the market for the vast majority because it's set by the federal government. Okay. Now, what about the wider global economy? Well, the first way that it will have an impact is a weaker dollar. And I've said this before, a weaker dollar tends to be good for asset prices, also tends to be good for the export market. It makes U.S. firms more competitive in goods and services around the world. So that's one of the reasons why a lot of small caps did well today and likely will continue to do well, is because they have more exposure to the domestic market. They tend to be more domestically focused, and they're meaning domiciled domestically, their production, their service, etc. And their business tends to get a tailwind more than most from a weaker dollar. In addition, the lower borrowing costs will help them refinance their debt at a cheaper rate, which will help them stay in business, be more profitable, hire more workers potentially, etc. And those will be the wider global impact of the rate cuts and the future rate cuts coming down the pipe. All right, let's take a look at the market today. It was a decidedly positive day overall, and this was the follow through from a larger than expected cut yesterday. And you certainly had the strength on the growth side of the market and small caps. Small caps did very well. You had the NASDAQ up about 2.5%, S&P up 1.7%, kind of along with the broad U.S. market. Small caps on average were up nearly 2% overall. So that was definitely some of the strength on the back of, as we talked before, lower rates will disproportionately benefit those larger companies. And so you saw some nice moves overall. Of the most active names, you had NVIDIA up 4%, Tesla up 7%, Intel up 2%, NEO bounced back at 7.5%, Apple up nearly 4% there. Plug Power was down nearly 2%. That was also one of the more active names out there. You still had some big losers. Hertz down 7%, Rocket Companies down 6%, Trump Media once again down about 6%. And let's see where the big movers, any other big movers. A lot of pharma, a lot of biotech companies were up well because of those lower cost of capital. So very interesting follow through at all-time highs. You had gold up as well. What did the dollar do? Dollar was down. Obviously, we know that is good for asset prices in general. The VIX was down. So despite this being a seasonally weak part of the market, obviously they like this 50 basis point cut, even if the prognostication of future rate cuts were not as dovish as the market was pricing in. So very interesting. We'll see if we get some follow through. Because that's what you want to see when you get to a new all-time high. Is there a follow-through the next day, or do you get a near-term setback? So we'll be watching for that as we close out the week tomorrow.
Hey, Justin and Luke. This is Chris from Atlanta. With the interest rate cuts, I was looking at the markets this morning. I see that some of my utility stock, American Electric Power, actually is one of the few stocks I have in my portfolio that is kind of down on the news. Is that because of the interest rate cuts? Would it be a good time to trim that and have money available for other sectors that might do better at this time? I'm interested in hearing your feedback and just seeing what you thought. Thank you for everything.
All right, looking at American Electric Power, and this is actually a utilities. We don't own a lot of utilities, but it is one of the utilities that we own for clients. And it has rallied. The whole utility sector has rallied because the utilities are a bond proxy. Okay, when interest rates drop, that the interest-sensitive sectors tend to rally with bonds. Okay, so think of utilities and REITs. Those are two of the, also consumer staples as well. Those are three areas that tend to go up when bond prices go up, meaning rates go down. And that's what you've seen as of late, right? The 10-year topped out back in, when was that? Late April at 4.7%. And we recently bottomed around 3.6%. But since the Fed cut, and this is a great example, this is the lesson you have to learn, you have to understand, is that these news events, they're priced into markets. And so what's happened since the Fed cut yesterday, the rates went up because the future path of where they expect rates to go was not as dovish as the market had been pricing in. So the market adjusts and rates actually went up over the past couple of days. And just as these sectors rallied, utilities, REITs, consumer staples, just as they rallied throughout the last few months as rates came down, now they're selling off just a bit. And so is this a good time to maybe trim a little of your rate-sensitive sectors? Yeah, maybe. It also depends on the percentage of your overall portfolio. If you have other opportunities that you think could be better as well, this would be a place to maybe trim back a little bit. Still like it. It's one of the best utilities out there if you want to own a utility name, just based on its geographic diversity, mainly focused on Arkansas, Indiana, Kentucky, Louisiana, Michigan, Ohio, Oklahoma, Tennessee, Texas, West Virginia, and Virginia. That's where they operate the electric utility. And these are regions that there's a lot of growing demand. especially people moving to those regions, but also a lot of the data centers, AI data centers, cloud data centers are being built in those regions as well. So that's why American Electric Power has been, so strong. Relative strength is 84 right now. So I like the name. I like that you own it. If you have other opportunities, this is probably a decent time to trim back a little bit. But a lot too depends on your utility exposure and your exposure to this name in general. Now, we hope you've been telling your friends that the audio podcast is now available in video form over on YouTube. And we had questions submitted via the comment section. And Jared Williams, B7I, says, Justin, love the show. I've been listening for years. I think the InvestTalk team have the best knowledge and insight into commodity companies. I'd like to ask your thoughts on VRN, formerly Crescent Point Energy. This name's been on my watch list for quite some time. Can you please provide your thoughts on the upcoming show? Well, I sure can. Looking at VRN. And this is a Canadian company out of Calgary, Alberta, Canada. It's a E&P company, explores for oil and gas in central Alberta. And earnings were $2.12 last year, but only 37 cents expected this year and $1.03 next year. And that is kind of the issue here, is if you look at this compared to many of the other Canadian oil names, they're just a lot stronger. This is a pretty small one, only about $3.4 billion market cap. We own a Canadian name that's a lot more diversified, and that's a $72 billion company, and its earnings are down, expect to be down this year, but not nearly as much as VRN. And that is my issue. I just think there are better Canadian. I like you're looking at the Canadian oil names. There's a lot of good quality companies that are out there. The problem is that they have a decent amount of debt in their balance sheet. They're not nearly as profitable. In fact, the return on equity is now negative. You don't want that. So, long term, it doesn't have bad assets. It's a kind of a middling Canadian oil name. I don't have a huge issue with it, but in general, I just think there are much better opportunities out there. So I'm going to pass on Veren Energy. That's the first time I said that. I haven't looked at this since the name changed.
Hello. I was thinking of buying Charles Schwab stock, SCHW. I'm wondering if it's a good opportunity to buy it now or wait it out a little longer. Thanks. Bye.
All right. Looking at Charles Schwab, and this is also a name that we own for clients. It has pulled back on the recent earnings into the low 60s, but it's holding there, and we still like it. We like the acquisition of TD Ameritrade. And the consolidation within the industry just gives them a lot of ability to have scale. It's a scale business. You have a lot of money, a lot of clients to serve. Obviously, we custody our client assets with Schwab, and they do a good job. And it's a good business. Now there are some near-term issues with their lending services, and they need to find a way to capitalize on their deposits in a better way. But I think over time they will solve that, and that gives more upside potential to the name. So we own Charles Schwab, and we like it. Now let's play another question from 888-99 chart.
Just had a quick question on VF Corp, ticker symbol VFC. I just wanted to get your guys' thoughts and opinions on whether you thought this would be something for kind of a longer term buy, 3 to 5 years. But looking forward to your answer on the question. Appreciate everything you guys do. All right. Bye.
All right. Looking at VF Corp. And this is a company that owns Vans, North Face, Timberland, Ultra, and Dickies. So it's a small time retail operation now, right? A distributor. And, the issue has been their debt levels. They do have about $5.5 billion in net debt and a market cap of $7.2 billion. And the issue was that their free cash flow turned deeply negative at the end of 2022 and even throughout 2023. But it's now positive by about $700 million. And that puts them in a much better financial situation to be able to take that money, that cash flow, and pay down debt. And that's what they need to do. They need to right-size their balance sheet. And debt did peak out at about $6.7 billion of long-term debt earlier last year. and now it's down to a little under $6 billion. So they have used that free cash flow to improve their debt situation. Now the chart is improving, okay, and I think this was a decent risk versus reward, but understand it's still very, very high risk.
Hi, Justin and Luke. I was calling in to get your opinion on a fund I was looking at. It's the Vanguard Intermediate-Term Corporate Bond Fund. The symbol is VCIT. And also I was looking at Vanguard Intermediate Treasury Index Fund. Symbol is VGIT. So I just wanted to see what would be a better fund, corporate bonds or a treasury fund in this environment when the interest rates are going down. And I would just want to use my investment to draw income from later on when I get in retirement, maybe in about 5 years from now. So I don't know which type of fund would be best, the corporate or the treasury type of bond fund. So I'll be listening to the answer on your show. Thank you.
All right, looking at VCIT versus VGIT. And VCIT is the Vanguard Intermediate Corporate Bond ETF, and yields about 4.7%. And its effective duration is at about 6 years. Okay, let's remember that, 6 years. And then the other is the VGIT, which is the Vanguard Intermediate-Term Treasury ETF. Its effective duration is about 5 years, so a little bit less duration there, but it's only yielding about 3.6%. So you're getting over 100 basis points better in yield from the corporate bond one. Now you're taking a little bit more duration risk, one more effective year. But frankly, I don't think that that's too much of a worry at this point. If you're comparing apples to oranges here, or apples to apples, between these two funds, I rather take the credit risk. The credit markets seem fine. Corporate profits are good. A lot of the bad risk, bad debt that is out there is more in those private credit funds and private equity funds, et cetera. So I think there's a lot more safety in the corporate bond market than there has been in the past. And so if I'm picking one or the other, I'll take a little bit more duration risk and picking up a whole over 100 basis points increase in yield and buy the VCIT over the VGIT. Thanks for the call. There's another question that came in from our InvestTalk YouTube channel. What do you think about Progressive? They're constantly growing their revenues. Their PE looks low to me. Is it a good chance to pick it up? And this is PGR is the symbol. And let me pull this up here. A little bit of dividend here, just consistent grower. Earnings were $9.66 in 2020, then went all the way down to $1.18 in 2022. Now expected to be $13 per share, all-time high this year, and $13.31 next year. It's a $255 stock. So based on forward-looking earnings, you're talking about a 20 multiple. I wouldn't say that's low, but it's fine. It's a good business, and it is an insurer that consistently produces good cash flow, has a solid balance sheet, obviously a good brand there. And return on equity high, 35%. So I like Progressive, but it is a little overbought in the near term. I would need this to come back and have a little bit of a consolidation period, but I like it. I like the profitability. I like the business that it's in. And that dividend, while very small, has a lot of room to run. And this is a perfect example of, I would much rather own this than a lot of the high dividend payers that are out there because of that strong profitability. $13 billion in free cash flow. Now, the market cap is $149 billion, but once again, no debt there. So I'm going to give Progressive a thumbs up. Thanks for the call. Now let's touch a bit on 529 plans. And there's been a lot of recent changes to the 529 laws that allow a lot more flexibility. And one is the ability to roll a 529 plan, unused parts of a 529 plan, into a Roth IRA. And think of students that might get a scholarship, or they choose a lower cost school, or they just took a different path in life. Maybe they just went to a vocational school, or maybe they just didn't go to post education. They went straight to starting their own business, or straight to a job. So the law that took effect this year allows unused 529 funds to be transferred to Roth IRAs tax-free up to certain limits, though. And that's the important thing, is that there are limits here. And it's meant to be a modest solution to a modest problem. This isn't something you're supposed to load a bunch of money into and do these tax-free rollovers, okay? And so there are limits. Now, there are rules. The key limit here is that the 529 account must be open for at least 15 years. Okay, and the rollovers cannot be contributions added in the last 5 years. So this is something you don't set up and you figure it out, how to use this loophole in a short period of time. This is something that is 20 years post actually setting it up. So hopefully it's for a child. You set it up when they're toddlers, and then they get to college age, and they don't use all the funds, or they don't use it at all. Now the rollover funds must go directly from the 529 plan into the IRA owned by the beneficiary, the Roth IRA owned by the beneficiary. Okay, so that's important, and it cannot exceed a total of $35,000 per beneficiary. You can't, $35,000, it's a decent chunk, but it's, not life-changing for most people, okay? Now, someone who owns several 529 plans, say for children or grandchildren, they could have a $35,000 rollover limit for each. So, this is per beneficiary, okay? Now, another rule is each recipient must have at least as much earned income as the rollover. Okay, so that $35,000 limit, if they're only working part-time, let's say they got a job instead of going to college and they're making $20,000 a year, that's the limit of the rollover in that particular year. So you might have to do it over multiple years. And then the normal contributions limits also apply. So that counts as contributions to the Roth IRA as well. So you can't add Roth contributions on top of that if it exceeds the limit of $7,000 per person. Now, the good news is the income limits don't matter. So maybe the child is, or the young man or woman is an entrepreneur. They have their own business. They're making a lot of money. You can still do the rollover, even though the limit for Roth contributions is $146,000 for single filers and $230,000 for joint filers. So income limits aren't an issue here. There are some states that will impose a tax on these rollovers, so be careful and check on that in your individual state. Now, when it comes to switching beneficiaries, this is big as well. New beneficiaries could be from a younger generation, like a grandchild. So it doesn't have to be to go from one child to another. It can go from a child to a grandchild as well, and that's a big change on top of that. So pretty interesting shifts here in the 529 realm, and a lot that can be done if you have one that is unused. Now let's keep things moving and roll in another listener question. This one came in to our voice bank earlier this morning from a caller here in California.
Hi, this is Francisco from Stratford, California, and I'm calling about a REIT. Ticker symbol is ELS, Elephant Luxury System. And I was just calling, I'm trying to get in the REIT space, and I was wondering what your evaluation is on this company. When I did a screening, it looks like it had positive revenue growth and positive earnings growth moving forward, but I was wondering what your paid data subscription says about it moving forward. What's it look like for a 5 to 10 year hold? Appreciate what you do, and have a good day.
This is an interesting one. Equity Lifestyle Properties. It's a residential REIT. Most people think residential REIT, they think of apartment REITs or something like that. But no, they own manufactured housing, residential vehicle communities, and marinas. So think of low-cost mobile home parks across the country. And they have 451 properties across the United States, mainly in the Sun Belt region. 38% of their properties are located in Florida, 12% in Arizona, and 8% here in California. And it's about attractive retirement destinations. For over 70% of the company's properties are either being age restricted or having an average resident age over 55. So these are think of your warm regions with a lot of people retiring, and with the baby boomer generation continuing to get older and move into retirement. This is an area that is obviously getting more and more demand. Now, this has rallied with the REIT space from a low of around $60 earlier this spring, and now we're at $73.57 at the close today. So I actually kind of like these type of REITs. Return on equity is 24%. I like that. That's pretty high for a REIT. They have a pretty good balance sheet, only about $3.5 billion in net debt. Now, most people look at the dividend yield of 2.5%, and they think that's not very high. That's not high enough. But they have a very high profitability for a REIT, which I like. They have consistent growth pretty much every single year. Earnings were $1.81 in 2017, or say funds from operation were $1.81 in 2017. And that has gone up every single year, even through the pandemic. Supposed to go up 4% this year to $2.90, and then another 6% next year to $3.08. And they have a lot of pricing power, because they can, remember, these mobile homes are sitting on their land, and they can raise the rent slowly each and every year. So this is a nice inflation hedge. It's a consistent business. And of the REITs that are out there, I'm actually going to give this one a thumbs up. I love that he's calling about it. It's kind of a unique one, focusing more on profitability than that high dividend yield. And that's another reason why I love it. So I'm going to give ELS a thumbs up, even though near term, I think you could have a bit of a pullback.
Here's a quick reminder. The newest InvestTalk Wealth webinar is happening soon, Tuesday, October 8th at 11 a.m. Pacific Time. The InvestTalk Wealth webinar will focus on effective strategies for managing your 401k and enhancing your retirement savings. Go to investtalk.com and sign up for our upcoming Wealth webinar, October 8th. It's free to attend, but you must pre-register. And please tell your friends.
I'm 70-year-old, retired, have about 25 to 30% in cash and bonds. And considering the current state of the economy, is it worth considering getting out of bonds and going into value stocks, more into value stocks? Thanks for all you do. Bye-bye.
The simple answer is yes. Just look at what's happened lately over the past couple of years. Everyone has been falling in love with cash rates, how much money you can earn on cash risk-free. But what have equities have done? They've done double, triple that return per year. And we have to remember that in an inflationary environment, a modest inflationary environment, 3 to 4% inflation, is generally a very good environment for equities and not the greatest environment for bonds. Yes, the bonds have rallied over the last 6 months, and you're going to get that. But in general, bonds rates are headed higher. And so that kind of limits the overall return that you're going to get from bonds, because bond prices, obviously, if you take duration risk, and that's a big question here, is how much duration risk you're taking, those longer duration bonds are going to get hurt. And this is a perfect example. You're a perfect candidate for a portfolio review. I encourage you to reach out, go to investtalk.com, fill that out, so I can understand, what type of risk level should you be taking? What is your tolerance for risk? That's a big question here. That's what we would look at. Also look at your weighting of your bonds and other assets, and see, should you increase your weighting in equities? And obviously, value stocks, I think, are a better place to be. But just in general, that's the first question: is how much equities should you have? And so it's hard for me to say, should you put X amount into equities without understanding your broader situation. But if we're looking at, in general, should you be selling your bonds more and buying more equities? Yes. The general answer is yes. Now, that doesn't mean you go 100% there. Maybe it's, trimming 10%. Maybe it's trimming 20%. I don't know. Everyone's situation is a little bit different, but equities will likely continue to outperform bonds for the foreseeable future, as long as liquidity remains relatively robust. And when the government spends a lot and banks are lending a lot, that tends to be a backdrop that's good for economic growth and earnings growth, and thus equities. Now, I want to talk a little bit about a new type of fraud. It's called the pig butchering fraud, in which scammers build victims' trust and then convince them to invest in bogus schemes. And a lot of these victims, they've never told anyone before. A lot of them are embarrassed to admit they have fallen for these type of scams, and a lot of it has to do with online dating, online. They basically they have these online profiles that look like real beautiful women and that are successful and independent, and they prey on men that are oftentimes, they're lonely and they're looking for that connection. And over many weeks and sometimes months, they build this connection online, and it's estimated that millions of people across the world have fallen victim to these type of scams, siphoning tens of billions of dollars into what are transnational crime syndicates each and every year. Not in total, this is each and every year, tens of billions of dollars. Okay, now it typically works something like this. Gangs run mainly by Chinese fugitives set up criminal enclaves in places such as Myanmar, Cambodia, Laos, where law enforcement is very weak. And these people sit at desks all day, manning fake social media profiles. And they seduce people online, convince them they're in love, and then get them to pour money into bogus investments. So they call it pig butchering scams because the swindler fattens them up, right? Gets them all warm and fuzzy and gets them excited that they might have met somebody that they connect with, and it builds their trust. And they butcher them, take them out to slaughter, taking the money and then disappearing. And this is, once again, these aren't just isolated incidents. There are thousands a year. Now, what's interesting here is that some of the scammers are often victims themselves, forced into this type of role by job posts of customer service or tech support, and then the traffickers confiscate their passwords and force them either by threatening them or torturing them into compliance. So that's what's even crazier too. It's criminality run amok, and the money moves very quickly through shell accounts and unable to be traced or frozen, and across various jurisdictions, and it's very hard to fight back. Now, so far, the FBI sees billions of dollars are swindled each year from U.S. citizens, and this is not going anywhere. Okay. And now a few crackdowns have happened. Earlier this month, the U.S. Treasury Department sanctioned a Cambodian politician and several business entities for their involvement in these type of scams, but nobody's really going to jail, and that's why they run amok. Like, the worst case is, hey, they reverse some of the charges if they don't hide them well enough, right? They don't get them into the right bank accounts fast enough. And mainly because they're working in places where law enforcement is weak, corruption is all over the place. And so it's very hard for this to be stopped. But the one way you can stop it is letting people know about it, being aware of it, and knowing that, never send money to anybody you don't have full 100% faith in, that this is who you should be sending money to, and what you're getting back in return is what you are expecting. So be very aware of this, because this is a type of fraud that is running amok. Okay. No, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And head over to our YouTube channel and like some of our videos, and make sure you subscribe and hit that notification bell. And please tell your friends about our upcoming wealth webinar on October 8th, 11 a.m. Pacific time, focusing on enhancing your retirement savings and effective strategies for managing your workplace retirement account. Independent thinking, shared success. This is InvestTalk. Good night.